Thank you for joining Understanding GP Stakes, How to Access the Top of the Real Estate Investment Food Chain webcast. Today, you're joining industry veterans Rick Courtney, Dave Seymour, and John Azar as they discuss how multifamily real estate investing has changed and why rising interest rates and declining yields in hyper-competitive markets require a different kind of investment firm to be successful. With that being said, I'm going to hand it over to Dave Seymour.
Thanks, Jeremy. I appreciate it, man. As you can see, I'm one of those guys who doesn't like an immense amount of silence. I couldn't wait any longer to start this fantastic opportunity and webinar here. My name is Dave Seymour. I'm an industry professional, but today's webinar is based on the offerings and the processes that Essential Realty Partners have put together. We'll be with you for approximately an hour, maybe a little bit longer, as we get into Q&A at the end of the presentation today. I will moderate. The format is very simple. First of all, there'll be an introduction to the partners at Essential Realty Partners. We will take a recap and their perspective on market conditions today. We know that they are fluid, I think is a good word to use, to say the least. Recap of the market conditions, and at that point, we'll review what is private real estate, private equity real estate. What is it as a company? What is its positioning in the marketplace? If you're on this webinar, we assume that you are a seasoned professional. However, covering those fundamentals is always important. Then we'll get into the GP stakes, what this team has put together for you, the investment community, an overview of what that offering looks like. And then we'll wrap up the webinar today with some open Q&A, good interaction. We made a decision as a team here not to, just go through PowerPoints and click and talk. We're going to make it interactive, communicative. We find that a lot more engaging so that everybody can take away massive value from this webinar going forward. So without any further ado, I will turn it over to Mr. Rick Courtney, founding member, partner of Essential Realty Partners. Rick, it's all yours, bud.
All right, thanks, Dave. As Dave said, we're not going to bore you with slides, and the first thing I'm going to do is throw up a slide on our introduction of Essential Realty Partners. I want to give you a little background of who we are. We're a new private equity real estate company. We're founded by a very elite team, as you see as we kind of skim through the presentation today. We do have a focus and a specialization in middle market rental housing that is comprised of not only traditional multifamily product, but also the new build to rent product, which are subdivisions that are built for rental instead of for sale. And we're based in Dallas, but we're going to have a national footprint. And the reason that we're here today is we're positioning ourselves for what comes next. And as we get through this, I think that will start to make a little more sense. Just a little more background on us. Our principals have, over our careers, raised over $3 billion in deal level capital. Essential is going to be an all-weather shop, which means that we'll be executing strategies in every phase of the cycle. So in certain phases, we'll be doing new ground up development. The phase that we're coming into, in our opinion, we're probably going to be more opportunistic. One of the things that we're doing differently, and quite frankly, because we're entering at this point, is going to be a strong competitive advantage for us, is next generation technology. And this involves some really cool AI, predictive analytics, machine learning, things of that nature to really cut down the time that it takes to source the best deals out there. As I mentioned, we're going to have a national footprint. We're targeting high growth markets, and these markets are always dynamic. They'll be changing as the econometrics change that, tell us where we need to deploy capital. Again, our founding partners, a very, very seasoned team. If you look at us, we cover every aspect of the multifamily life cycle, whether it's investment, development, operations, of GP firms like Essential is, international operations. We have a absolute elite team that are the founding partners. A little bit background just to let you know how we're unique. And some of these things we feel are really critical for the environment that we see coming up. And the first thing that, I'm going to reiterate is that, our founding partners have over 150 years and 4 decades, and more importantly, multiple cycles of operating wisdom. And we think that insight is what is going to be critical in the new environment that is emerging right now. As I mentioned, we also think that, this is an opportune time to deploy next generation technology. And what we're doing, again, you saw me say that we're positioning for what comes next. We're getting ahead of some industry megatrends. We'll kind of go over those as we go through the presentation. We're going to have an end-to-end institutional level platform, and we're doing something different. This is a proven technique and a proven strategy, and we can go into that a little bit later in the Q&A. But we're capitalizing ourselves with a GP stake, and this is something that most new companies don't do. They don't offer this type of opportunity. They don't want to share. Our situation is a little bit different because we see a window of opportunity that we don't want to miss, and so we're doing something different with that. Our offering, just a quick profile, and then we'll get into the meat of the presentation. And this will be available if anybody's interested in talking to us about coming in with us as a capitalization partner. Of course, we can have one-on-one conversations and get to know each other and go through the journey there to see if we're a good fit. But this is our offering is a very powerful offering. We're combining, a private equity company with real estate. It's a super powerful combination that offers venture level, or I should say private equity type returns. We've done very detailed 10-year financial projections on a 5-year hold, which we don't think many people will want to get out after 5 years, but on a 5-year hold, we are going to provide some exit options. We're projecting over a 12 multiple. So if you invest 100,000 with us, we're targeting to return to you about 1.2 million.
There's a lot of data to support those kinds of economics and projected returns. As an investor, I always try and put on my investor hat primarily, so that when I enter into these scenarios, I enter into these investments, I've got a lot of my questions answered prior to making an investment. You got it right there. It's on the screen. It's as bold as could possibly be, Rick. In this marketplace, there are some investors that run and hide, and then there are educated investors, like this team, for example, that know how to capitalize on what's going on in the market currently. Look at that inflation. Look at those numbers. I'm gonna put 2 questions out there because I know that they're both incredibly pertinent to the conversation. Number one, what is the goal, or what is the process for negating, if it's possible, the inflationary environment that we're in? I'll put that question to you, Rick. And then John, the silent but deadly partner sitting right there on the call with us. I'd love for you to open up some dialogue around the interest rate challenges that the capital markets are seeing, and how that affects the strategies that this team uses going forward. So I'm going to open those doors, guys. I'd love you to walk through them and debate that a little bit and share some of your knowledge and insight on that.
Okay. All right. Well, I'll kick us off since I'm already talking here, Dave. But I don't know if anybody on the webinar or their kids watch Stranger Things, the Netflix series, but if so, then if so, when it comes to inflation rate and increased interest rates, it's like we've discovered that there's an upside down world, right? Things that have only gone down have completely flipped over, and we're in a different world. And, it's causing a lot of anxiety out there. But we've seen this before, as I was a teenager, I lived through, the Volcker years, and, I've seen 15% 10-year yields and things of that nature. So, we will survive it. I'll give you, I think, answering your question, I think understanding and having the foresight that I talked about earlier, as far as how it's likely to play out is the best way to counter this inflation, because the inflation is really what kicked off the series of interest rate hikes that the Fed just announced. As you see here, if you ask 10 different economists, you're going to get 10 different opinions. This is a composite of 47 economists, real estate economists, by the way, from the Urban Land Institute. And they're basically showing a transitory inflation period. You can see that we ended up about 7% in 21. 22, they're anticipating it to settle about 6%. We're kind of trending that way. The last 3 months, I think we came in at an annual rate of 8.5, 8.3, and the last one came in at 6.2. So, by the time we get down there, it's very likely, that we're going to be close to this and probably get back to some type of normalization in 23 or 24. And, I think there is a very real possibility of a recession in here. But, to answer your question again, I think that, how you counter this is by having the insight to understand where we're going and position yourselves appropriately. And that's exactly what we're doing.
I've heard a saying, and I'll play devil's advocate, that multifamily and commercial real estate is the #1 hedge in an inflationary market. Like I've heard that said over and over and over again.
Who told you that? Did I tell you that?
You told me that, John. I don't forget anything you ever tell me, John Azar, my guru, right? My guru. Oh, look at that. I didn't even have the next slide, and it says it right there. Asset typically seen as an inflation against hedge. Unpack that for me. Like I think I know the answers, but I'd be interested on, you talk about longevity and being exposed to multiple cycles on your team. I don't think the value of that can be stressed enough. If you bring it into today, right? If you bring it into today's analogies, it's like, hey, I've played this video game before. I know what's coming next. So, how to unpack that, John, Rick, either of you.
If you've been through a couple of cycles before, you know what the next level, of Donkey Kong is going to be. So what barrels you need to jump over that are going to be coming your way. I'm dating myself here with Donkey Kong, but it's the last slide that we had up on inflation. There's a huge amount of correlation. And there's a recent report that I should have had up here as well from JP Morgan that shows in an inflationary environment where the GDP and the inflationary rate are overpassing the 10-year treasury, which we already are in that space right now. I mean, we are certainly well in that space right now. Real estate tend to always overproduce every other sector, meaning stocks, bonds, and stock market driven assets. So I mean, that's not assumptions. That's a fact. If you look at historical trends, we know due to our past cycles, we know that. And listen, by the way, what Rick said earlier about as far as what's coming, it's not what's coming anymore. It's already here. We're already seeing a lot of the changes in the marketplace taking place right now. We're already seeing the effect of higher interest rates in the marketplace and what it's doing to deals across the sector, especially in multifamily. I mean, we are multifamily, we are multifamily operators, all of us. And I see it on a daily basis. Me and my team are entrenched in multifamily on a day-to-day basis. The fact that you're seeing, for the first time in 3 years, you're seeing deals coming to market, get priced, get bid down from that price. And then after somebody wins those deals, they go back and retrade and the price keeps going down after somebody wins the deal is unheard of. I mean, that has not happened in more than 3 years. That probably has not happened in the past 6 or 7 years. So And we're seeing that right now. That's not coming. That's happening right now in the marketplace. So what that's telling me is there's definitely going to be some kind of contraction in the pricing expectations and a more of an equilibrium between pricing expectations and the cap rates out there. Are we going to see now? That is certainly countered by higher interest rates, but at the same time, your buyer pool is truncating a lot during that time as well. So what you used to see 2 or 3 years ago, with the rise of interest rates, what that's done to the market is it really kind of weeded out some of the really, really aggressive players that really just that underwrote in an unrealistic format, that probably were too aggressive on their underwriting and their acquisition criteria, and who are now and will be paying the price in the future. And we happen to be hopefully the fortunate recipient of some other people's mistakes. So what you're seeing is, yes, there are higher interest rates that are coming into the market. They're already in, and they're going to continue to probably continue to rise for, I would say the foreseeable 5 or 6 interest rate rise that are going to be expected, that are going to be coming from the Fed this year and into the beginning of next year. But then you're going to see an equalization. And at that equalization point, that's when you're going to see probably the biggest buying opportunity. So I'd say between the next 6 to 18 months, you're really going to start seeing some really, really, really interesting buy side opportunities out there for folks like Rick and myself.
So let me ask you guys a question then, because this is so on point. We've been in a highly competitive market, I would say, for the past 12 months. With compression of cap rates, the seller has always been in the driving seat. If we went online, we know we could find 1,000 syndicators brand new out of the box in the aggressive environment that's been out there. I mean, my question would be, is this competitive environment, you guys see it flipping over towards the longevity players? And I say that with respect to all of us on the call. If we know what Donkey Kong is, it means we've been on the planet a few years, right? So we've seen those market cycles. Anybody who says I've seen it all, and they've only been in the business 10 years, is probably somebody we should run away from. So my point is you see the market compression releasing a little bit, massive opportunities. So he or she who is the most well capitalized to pull that trigger at the right time, that's where we're getting these success pro formas that we're talking about with the offerings on the co-GP. Why don't you talk a little bit about success requirements for the new investment environment? I mean, what tools, Rick, do you have to have in your toolbox to really maximize this opportunity that's in front of us, especially when we start looking at cap rates nationally and what we've been going through recently?
Excellent question, Dave. And I want to, before I get to that, I just want to do a quick recap for those of us, out there that have more of an analytical bent. Nationally, cap rates are at 4.5%. But as you can tell, this is over the last 12 months. You take, let's just take Austin, for example. It's come down. Well, Austin's not a good example, but let's use Charlotte, 4.2 to 3.4. That's quite a cap rate compression. And so we've seen this, as you can tell from this chart, sort of across the board. And that's the type of environment we're in. And, a lot of this is information through the first quarter of this year, by the way. So this information was right before we had the tremendous run up in the 10-year treasury, which went up 53% in one quarter. And so that, what we think this has kind of done is presented a blow off top in the marketplace. And, similar to, when things get overheated in the equity and bond markets and things of that nature, we're hearing directly from brokers now that, the bid pricing is down 5 to 10%, the opening bids that are coming in on actively marketed assets. And more importantly, bid count is down about 75%. So what that is telling us is that the easy money has really been made.
Mm.
You know, the folks that got in, they really weren't operators, but they were folks that kind of rode the coattails or the tailwinds of cap rate compression and declining interest rates. Now, like I said, we're living in the upside down world where we have the exact opposite happening. And so it's going to require, you know, a different type of firm to be successful going forward. And again, I'm getting a little bit wonky here. You know, I know a lot of you don't like the analytics, but I think it's vitally important because, you know, this is, if you're looking at it from a strategic point of view of, you know, when do I enter the market? You know, what, you know, where do I from our perspective, for example, we're going to do a national portfolio build. You know, we're targeting roughly about $2.6 billion in 5 years in assets under management. So we look at it from a strategic level of saying, you know, what has history taught us? And if you look at this chart, this is, again, I'm trying not to get too wonky. The bottom line here is the 10-year treasury. The top line is cap rates. And, you know, there's always a spread between the risk-free yield, you know, which is the 10-year treasury, and cap rates. And as you can see in 2007 and 2008, that spread really almost inverted. I mean, I think it got down to 80 bips. The spread between the 10-year and cap rates that people were paying. And we all know what happened in 2008. There were some different drivers, and I'm not suggesting that we're going to have anything like that. As a matter of fact, I don't see that happening. But if you look at what happened right after this, you know, we went through this period, look at how that spread widened. One thing, cap rates went up, interest rates went down. Now look at where we are now, and this is even tighter than what this chart is showing right here. You know, we're showing that the 10-year at this point was 2.3%, and as of today, it's over 3. So you know, cap rates at a national average are 4.5. You know, we're 150 bips. So we're closing in right here. We're going to see another inflection point here, and what comes after that? This expansion of the rate. And if you're like us, you're looking to go big fast, you're looking to do a national portfolio build, it's a perfect setup. And, you know, that's what we're seeing as far as the opportunity. Now, Dave, I'm sorry, you asked me about success factors.
Look, time out 1 second. What you just showed in that data pull, that's the fundamentals of being successful. That's not just guessing. That's not just listening to 3 podcasts and saying, okay, I got it all figured out. Right. I mean, that's really relying on a track record going forward. So look, man, I believe that is, you know, that's the foundation on which you guys are working to be able to put this together with a high expectation of success. So I'll be quiet, but thank you. Keep going.
Okay, and I'll let John chime in here, but you know, now I'm finally answering your question, Dave. Sorry it took so long, but a couple things that we think, and you know, John and I have talked about this. John is in the capital markets every day, talking institutions. I mean, the institutions are just penetrating way down in the capital markets. I mean, you know, who would have thought that Wall Street would own single family homes, right, you know, like they do? I mean, you know, that was unheard of before 2008. And so the institutionalization of capital is continuing. You know, they're just getting a bigger and bigger share. And so you need to understand that going forward, again, I've already said the easy money's been made and capital is going to demand, you know, a new type of firm. Scale is going to matter. You know, scale is required to operate at the institutional level. Big data is going to be a requirement because just as we went through those charts, I know it's wonky, but the people that allocate capital, they want to make sure you've done your homework and that, you know, you're presenting defensible positions and well thought out thesis as far as capital deployment. And, you know, big data is required to do that. You know, things like, you know, cell phone traffic, you know, seeing things of that nature to determine, you know, location value. And more important than anything else, capital will obviously be drawn to the firms that can source the best deals. And that's where this this new technology coming in really has a benefit of separating the wheat from the chaff, in our opinion. Prop tech is no longer optional. I mean, to reach the scale that we're talking about, which is inherently a problem in our business. It's driven by deal junkies per se. They're very good at making deals, but they're not good at building companies. So they don't put in the infrastructure properly. And so they reach a certain level and then they find it hard to scale. We've been there. We understand that. And so, we're putting in the infrastructure upfront to do that. And so, we're putting in an end-to-end prop tech platform to make sure that we're there. And sorry, John, I'll shut up now and let you.
I appreciate that. No, I mean, all these are valid points. Obviously, it's the, yes, I am in the capital markets, and we have never been in a time that, institutional money has infiltrated so many little crevices of our industry that have, historically, you would have never thought that they would be interested in. I mean, who would have thought that, firms like Goldman Sachs would be interested in deals that are, I don't know, 5, 10 million, $20 million big. I mean, you would think Goldman Sachs wouldn't even bat an eye for anything under 100 million, but they are, because they know that the real money is in those smaller opportunities. And I say smaller, I mean, there's still decent sized opportunities that are in that 10 to $50 million in capitalization. Which is where Rick and I are going to be in, and which is where the area where we're in, on a day-to-day basis. So, and in order to get to that bigger slice of the pie, scale does absolutely matter. In order to scale up, you have to have the infrastructure, as Rick said. Utilization of technology, data points, and is obviously, it's no longer necessarily an option. It's you must have these things. That's a requirement in our industry. But furthermore, beyond the data, obviously, and beyond the tech and beyond the prop tech, there's still a sense of relationships and relationship management, because we are still, at the end of the day, a very, very relationship heavy industry. Dave, you can attest to that more than I can. I see it on a day-to-day basis. We are, a lot of the deals either come to our door or leave our door, or we make money because of good relationships that we have in the marketplace. So at the end of the day, the relationships that we create out of those dynamics that we put together and the infrastructure that we put together is really what's going to propel us forward. In terms of private equity, our private equity approach for doing this portfolio and being able to succeed like we want to, and we know that we can. Really, that's the same approach that a lot of bigger institutional players are doing. So we're not doing anything that is so novel and so different than some of the institutional guys are doing. I mean, all we're doing is really institutionalizing the approach to private equity investing in multifamily. And that's really all that Rick was talking about earlier. In order for us to get to that scale, in order for us to provide the kind of returns on the GP perspective, as we're hoping we can, scale has to definitely be part of the equation. And all these other factors, including utilization of data, prop tech, and obviously the utilization of partners is going to be very, very important as we continue to grow. Rick, I don't know if that answered some of the question, but and Dave, feel free to jump in.
Time is always, I always love these environments where you get in a room with your kind of people, right? And you can always learn as you're going along. But do me a favor, because I could go on for hours. Let's get into this review, if you will, of private equity real estate as a company, the GP structure, all of those, the meat of the movement of capital. Why don't you break some of that down for us, Rick, and unpack it for us at a level that we can all absorb and understand fully.
Sure. John, actually, I'm going to defer to John and let him go through the private equity company. And
that's fine.
If you don't mind, John, and I'll chime in, and then I'll talk about the GP stake. And
no, I'd be happy to do that. I mean, look, at the end of the day, when we talk about private equity, we're really just talking about the movement of capital. That's really all that private equity is. Private equity is just is the way that you structure, move, utilize, and extricate capital out of deals. That's all that private equity is. It's at the end of the day, you're managing expectations of the investors. You're managing expectations of your own business plan, and you're being diligent on how you execute the business plan on a day-to-day basis. Dave have heard me say this before. Rick have heard me say this before. You make your money when you buy, not when you sell. So, I think everybody, even my own staff have gotten sick of me saying that. And the reason I say that a lot, and the reason I say that all the time and incessantly, is because you can't buy on the hope that you're going to make money in 5 years. You buy knowing that you're going to make money because your business plan right now, taking into consideration all the factors in the marketplace, you've taken into consideration all the factors of your partners, your capital expectations, and what's going on in the market. If you underwrote in a very conservative, realistic, pragmatic way, you know that you can make your money even at worst case scenario, because you have stress tested your deals to an extent to where you know what the worst case scenario is, or act close to it. Obviously, none of us can have a doomsday scenario built into our underwriting. Otherwise, we'd never buy anything.
We'd never get out of bed, John. We'd never
get out of bed. We'd never get out of bed. I mean, look, some of my investors ask me, is this foolproof? No, it's not foolproof. Nothing is foolproof. Right. The only foolproof there is God and taxes. That's it. It's there is no other thing that is foolproof. If a meteorite hit our apartment complex, we're out of luck. But aside from that, prudent due diligence, prudent planning, and prudent utilization of capital is what we're talking about at the end of the day. So the movement of capital into the asset that we want to acquire, that we want our portfolio to be comprised of, utilizing prudent and very, very pragmatic underwriting mechanism and underwriting strategies when we buy the assets. And in managing the expectations of those assets, whether we manage them in-house or not, I'm not talking about the actual property management. I'm talking about the actual asset management and the management of the money, meaning you are the guardian of that money in order for you to manage it to expectations. And that you may have to utilize property management in different areas of the country that would be best in class for that area, that would get you to utilize your business plan the best you can. When I hire a property manager, or even when I have a property management manager in-house, the first thing I give them is the business plan and the underwriting. I share the underwriting with our property managers because they need to know what I expect to extricate out of this deal. Because if the property manager doesn't know what you're expecting, how are they supposed to perform to what you want them to perform of this property? How do they know how much to raise rent? How do they know how much to stick to budget? How do they know to keep expenses to that level? So you have to communicate all of that, and everybody has to be on the same page. So all of that working in concert really is what create this sort of private equity realm that we're operating in right now, and what we're trying to do with Essential Realty Partners.
Yeah, and I'd like to kind of dovetail onto that a little bit, John. The private equity structure is obviously very, very powerful. I mean, we've all seen Blackstone, we've all seen Bain Capital, KKR. The unique feature of the private equity world, is multiple income streams come to a private equity company. Not only do private equity companies as a typical structure invest alongside their LPs, but they also generate fees for services they provide to the funds that they sponsor. But the real kicker in the private equity structure is the carried interest or the promote, and that's by being involved in the private equity structure, you get a disproportionate share of the returns. And what that means is that, a typical deal, Essential would put in 10%. Let's just say we're raising 10 million. Essential would put in $1 million, or Limiteds would put in 9 million. We'd all get a preferred return, and let's just use 8%. So we share equal proportionate profits, distributions and profits up to that 8%. But as a performance incentive fee for private equity companies, after you reach a certain hurdle, then you start getting a larger and larger share of the profits. And so, say after 8%, then all of a sudden the cash flow goes 70% to the LPs, 30% to the GPs. And so if you look at the leverage that provides, it's no wonder that, private equity has kind of been, one of the predominant drivers of some massive wealth of the 1%. So just kind of dovetailing on that, John, a little bit into that.
I'm going to add one more thing to that. When there is capital involved, especially from a GP perspective, it makes the return so much more powerful because, as you know, or maybe some of the folks that are listening, maybe they don't know, all capital that goes into our deals, all capital that goes into the into our side, it all goes on the LP side. So all capital technically gets paid, whatever the LP payout is going to be. No matter whether you're a GP or an LP, all capital goes on the LP side. But if you're a GP, your capital then will benefit from both the LP and the GP side. So right. Your capital, you are earning everything that the LP will be earning out of the capital that's in the deal. And you'll also benefiting from whatever waterfall splits and benefits of the economics that are going to be bestowed upon the GP. So you're almost double dipping when you're putting a lot more capital into the equation. And that's a beautiful part about injecting more capital from a GP perspective into deals.
Absolutely.
Velocity of capital, right? That's the phrase. How do you velocitize capital? How do you make it work harder with a risk profile that still makes sense? Why don't you keep going on the slide here for us, Rick or John?
Yeah. Anyway, what we're doing, as I said, we're doing things differently. We wanted. I'm sure that most of our attendees are familiar with the private equity structure. Some very sharp financial minds, have registered. But we just want to give you a quick recap of that. But what we're doing is a GP stake, and it's something. The last numbers I looked at, there's about 20 billion that has been raised for GP stakes, but that's usually deployed at the top tier companies. KKR, for example, just recently someone bought a 10% stake in KKR, but that was mainly to buy out some retiring partners' interest.
I think that was Dave. Was that you, Dave?
Maybe. It's a secret. I've got NDAs. You can't ask me questions like that, John. Come on now.
So anyway, we're doing a little bit different. Most people, GP stakes, something they've never heard of, and we've seen there's been a few innovative companies that have used it, like we're using it to really leapfrog and springboard ourselves to a top tier company. First off, private equity companies, are also known as GPs, general partners, are sponsors. And that's where the name GP stakeholders came from. And what a GP stake is you're investing in the GP's operating company instead of one of their funds. And, a way of thinking about this is a Blackstone. Blackstone was formed in 1985, I think, with a seed investment of 400,000. Last year, they had net revenues of 29 billion. And, it's hard to even get in some of Blackstone's funds for, a lot of the smaller players. But just imagine if you were sitting on top of every fund that they've ever done. And, that's what a GP stake would do for you. And so a GP stake is a way to own all the economics of a private equity real estate company. And it truly is getting access to the very top of the real estate investment food chain. So it's an investment in the GP's operating company instead of one of their funds. And, the economics of it, like I said, it's a way to own all the economics. And if you just look at, a real simplified version of it here, most of us understand, a typical structure here where you have a general partner and limited partners. If you're an LP and you've been allocating at the LP interest or LP level, say you allocate 5 to 15 million a year, you're getting your investment returns and your profit splits, and you may do some side letters, to increase your pref or reduce fees or things of that nature. By being a GP stakeholder, you really reverse, some of those costs, that are negotiated with side letters over here. And so as an LP, generally speaking, you get two income streams from the GP. Not only do you get the two income streams, the returns and profit splits, distributions, profit splits, but also, like I said, you reverse that flow of fees. So instead of paying fees, you get fees. And most importantly, we went over the carried interest and the promote and how that really hypos things. A typical deal, a GP will make 2 to 3 times, a return that an LP would make. So if an LP, for example, is looking at an IRR on a 5-year hold of say 15%, the GP is probably looking at 45%. So that's really the difference on the GP stake. It's a very, very powerful way to leverage it. And I'm going to go over some strategic features here, especially for companies that are, as I mentioned, allocating on a regular basis at the LP level. These strategic features are something to think about for a GP stake. Like I said, we just went over, you got multiple streams of cash flow coming in from fee revenue, your investment, co-investment returns. More importantly, you're really leveraging into every deal, because if you're on the top and you're in the parent company, every fund that company sponsors, you get an interest in. And so what that does is it leverages your investment to achieve scale. So, for example, Essential is going to have a national footprint. And as you saw, we go anywhere from core and development all the way to opportunistic. So not only would it be a way to diversify geographically, but also strategically. And one relatively small investment can be used to really, leverage into a huge, massive asset base. By investing at the company level, there is private equity return multiples. We're showing a 12, and if you're investing in real estate, you're looking at 1.5 to 2. Generally on a 5-year hold. That's the difference now. About 50% of our proceeds will go into real estate from this offering, and the rest of it is allocated appropriately. And again, that's beyond the scope of this webinar, but we're happy to go into that with anyone is interested in it. And the really cool thing about this, and something to keep in mind, one of the reasons that we're doing this is for legacy cash flow. And, this is generational wealth. I have 3 kids, and, we all want our children to do well. And, if we can give them, some legacy cash flow, that's what we want to provide. And, since GP sit on top of such a massive asset base, for example, we're targeting 2.6 billion in 5 years. The fees that come from that and the profits and all those cash flow that we're talking about are just tremendous. And so the potential is truly there, and you can see why the private equity structure has been used by so many of the top 1% to generate that kind of wealth that I'm talking about.
I want to add, Rick, that on top of the GP stake, and I want to clarify, and I think what you just went through right now actually clarifies one of the questions. We have some questions that we'll probably have Dave help us answer or go through it later on. But one of the first questions that came in is how do you expect to return 12x returns from an investment? And that's exactly why what Rick just went through right here. You're essentially double or not triple dipping on opportunities because you're on the GP side, because you're making the money on returns and fees from every deal, but you're also leveraging those deals to get into the next deal. So you're almost doubling down on the money that's available, that's invested in every deal, and utilizing it for the next deal, and so on and so forth. So the average LP returns, as Rick indicated earlier, is probably about 2x. or let's call it even on the best case scenario, 2.2, 2.3x. The average GP returns are usually out there on a deal is usually around 4x or so. If it's a good deal, 4 or 5x. But you're talking about in the lifetime of this, of doing multiple deals, and that's how we're getting to that 10 to 12, X scenario that Rick is talking about.
I think.
Yeah, and further clarification, John, and keep in mind that we're not talking about a real estate deal here. We're talking about a corporate deal. We're talking about a company, and so you're investing in a private equity real estate company, not an individual deal. You're right. Investing in a company that's going to do many deals, and by investing in the company invests in each of the deals that it sponsors, and so you're going to, through that methodology, you're going to leverage out into real estate. Now, like I said, a portion of our offerings invested directly, but to answer the question of how do you return a 12 multiple, it's because you're investing in a private equity real estate company. And, as we mentioned, there's already a market for GP stakes. That's one of the exit options that we're going to provide in 5 years. We've got multiple exit options for anybody. But, once we reach a scale, our target is 2.6 billion. Then you're not going to have any trouble finding buyers for a GP stake out there. But I do want to differentiate that it's not a real estate deal. This is a deal where you're investing in a company, and so the company just happens to be a private equity real estate company.
Right. Yeah, that's a good clarification, Rick.
Yeah. And just to, I'll piggyback for time here. We have obviously we're in the capital markets every day. I've been involved in designing and planning Central's infrastructure and platforms and things of that nature. But we have been out in the marketplace. We went out with a little test offering of 150 million and at deal level, and we got back term sheets of about 3 times that. Co-GP, JV allocators at the deal level. We're not going to have any problem. One of the things I'm working on is making sure that we have our acquisitions team boots on the ground in each of our target markets. We're using a structure that I've used successfully throughout my career for that. Also next gen tech, we've rolled out some of the base of that, and we're tracking deals. That's how we're sort of timing our entry and things of that nature. So a little bit of a background of sort of where we are right here. We're ready to go. We're positioning for what comes next, and as we conveyed here, we think it's a perfect setup for market entry. A lot of anxiety right now. We always hear, I wish I would have bought back in 2009 or 2008. Well, what we don't remember is how scared, most people were back in 2008, 2009. So it's always hard to sometimes see the opportunity when there's a lot of anxiety in the market, like we're experiencing right now, sort of this upside down market that we've been talking about.
I'm listening to you guys, and I'm thinking of, I like to simplify, right? I'm a 1, 2, 3 kind of guy. And that 12X question, for me, it's a case of, I'd much rather personally in my own investments own a little piece of a lot rather than a lot of a little, right? It's that diversification, owning a piece of that private equity real estate company and riding all of the waves, if you will. Because look, some deals are going to be home runs and unicorns. Some deals are going to be singles and doubles. And, it's being able to participate in all of that to create that, again, velocity of capital going forward. So it makes sense to me. Are we at the point, gentlemen, where we can hit some of this Q&A? Do you want to, I've got quite a few questions here.
Yeah, I think we should. And for the benefit of time, we should definitely start taking a lot of the Q&A.
All right, let me hit some of these, and you guys take them as you see appropriate. First question is from Natalia. She's asking the GP stake or the co-GP. Is it just for LPs who've invested with you in the past, or is it an opportunity that's available to any investor now?
Yeah, no, we thought about this long and hard about, how to structure this. And the answer is that if you're an accredited investor, it's available to you. And, we wanted to be inclusive. And so we actually put a lower minimum. I mean, we could have put, $1 million minimum on this, but we know that there are some accredited investors out there that understand this structure very well, and that they might want to take, that get to the top level. They understand the structure. Maybe they want to be on the side with us now, where they're really at the top of the food chain, the most elite and lucrative level of the business. And so we wanted to provide that situation. We do anticipate that most of the offering is going to be taken down by, family offices and, the smaller private equity firms and RIA firms.
So the availability to an accredited investor, what is that minimum, Rick? Is that already been established, or is that still fluid?
No, it's we decided to go low on this. Like I said, we don't anticipate a lot of this being available, but if you're an accredited individual investor and you like what you've seen, and you want to talk to us to see if there's a fit, you can get in for as little as $25,000 to leverage it. And so it's we said it that way. We de-risked this offering as much as possible. We made it a preferred offering. That means that you get a 10% return coupon on your money before the founding partners see anything. And that's cumulative, not compounded, but cumulative. We won't have distributions in the first year, according to our projections, but you will accumulate that 10%. It will be paid, once the fees start flowing in. So that's the answer to the question. We anticipate most of the majority of the offering being taken by institutional type players, but we wanted to leave some of it and make the minimum low for accredited investors.
No, I like it. I like it a lot. Questions come in here from Jay with regard to the uses of capital. I don't know whether you want to unpack what those uses are now. You mentioned a couple of times in the webinar that 50% of allocation is to acquisition, leaving 50% of the capital in there. Everybody wants to know where their money's going to work.
Yeah.
Right.
Yeah. Well, yeah. For time, we won't go into all of it. I will say this, that roughly 50% of that is going to go into our. You saw a typical structure where we invest alongside our LPs. So roughly 50% will fund our GP commitments for the first 18 months. The other is what we call pursuit cost. At any one given time, we want to have enough working capital so that we can have 4 different transactions in different markets tied up. And so that's a recyclable amount, but it's also a large amount to keep, the deals in play. We define middle market as individual deals between 15 to 75 million. Most of our deals are going to work out to be somewhere around 40 million probably. And so, to tie those up, you're looking at, 1% earnest money and things of that nature. It's this is a big money business, and, you have to have lots of working capital. So a large portion of this is going to go into our tech platform. We got some really cool next generation AI, artificial intelligence, the machine learning sector of AI. And, this is one thing that we want to get ahead of. And it's actually one thing that you can get ahead of by being a new company. Whereas you take an old company, it takes them 2 to 3 years, to make that digital transition. Whereas if you put the infrastructure in up front, you got it from the very beginning. So it gives you a competitive advantage. So those are some of the uses. And again, reach out to us. We'll be happy to walk you through, until you understand the financial projections, sources and uses. We're very transparent on that.
Yeah. Go ahead.
Sorry, David. No, I was just going to touch base on one thing that Rick said about the onboarding of technology and data. It is a lot easier when it's a company that is that is newer as opposed to an older company. I mean, commercial real estate in general is an industry that is very tough to move change on and adapt to technology. And mainly because, a lot of the older operators, it's very time consuming and onerous to onboard new technology because, a lot of operators that are old school, you're talking about having to convert physical files into data files. So it's very tough to onboard as opposed to a newer company that does not have those limitations and barriers into adapting of technology and technological advantages, such as Essential Realty Partners. So that's one of the main reasons why. And I just wanted to chime in on that.
I'll ask a couple of these questions in tandem because they're somewhat related. One of which is, do you accept 401k capital, self-directed IRA capital? And then also what the time frame is for exiting out of the investment. You've mentioned 5 years. Is there any movement on that number? Do you anticipate 5 years and out? Do you anticipate extensions? What does that look like?
Yeah, I'm sorry. I would have to ask you to restate the first part of that question. I caught the last part.
Resubmit my question, Your Honor.
Sorry about that.
Let me resubmit, counselor. Let me resubmit my question for the
The first part of the question is, can we take 401k money or IRA? Isn't that the question, Dave?
John,
Yeah, self-directed capital. Yeah, qualified money. Yeah.
Qualified money. Yeah. The short answer is yes, but you'd have to work with, we'd be happy to give you a couple of different providers that will help with, that we use, that could help you transfer part of your IRA money into an opportunity like that. We take IRA money all the time in our syndication. So that certainly could be workable.
Okay, cool. I got looks like an advisor, a registered advisor. The question is bringing their database of investors. Is there the regular industry compensation for an advisor that brings capital to the project?
Reach out to us and let's talk about it. We would certainly entertain it. Honestly, we haven't kind of thought about it. I think in our offering materials, and I think that our attorneys did allow that option.
Mm-hmm, mm-hmm.
Yeah,
Okay.
if they're associated with a broker dealer, then they probably would be an option that we can work with advisors to onboard some of their clients. So yeah.
Okay. You did mention that an investor would not expect any distributions in year one. The question is when could the investor expect distributions? Are you doing monthly distributions, quarterly distributions? What does that look like from a standpoint of receiving capital?
Yeah, we're going to have a corporate schedule of quarterly, and we anticipate distributions to begin in year 2. In year 5, and again, if we're happy, reach out to us here, and we're happy to take you through that to answer those questions in detail. Year 5, it's pretty impressive, but where it really gets interesting on the cash flow is when we start going full cycle on the deals. And again, reach out to us, and I'll be happy to tell you that. So the answer is that your distributions would accrue during the first year. There would be some payout in the second year. Again, keep in mind you're accruing 10% during this period, but the 5-year annual average is going to be about 18.1% annually.
Well, also, I want to emphasize one more thing. Participation in this is on the GP level, not at the LP level. So, the LPs usually have a lot more predictable, returns on investments. That's what they should have. They should have a predictable return, because when you go out and get LP limited partner to participate on deals, you want to pay them out and, on a regular quarterly basis. And then before you get paid yourself, and obviously, make the bigger cut at the end, as Rick mentioned, on a liquidation event. So this investment is on the GP level. So, you're essentially anybody who invests in this would be investing on the GP level economics, not on an LP level economics. So
which is why those economics are oversized in comparison to the LP in the first place, right?
There's a reason why those returns are oversized.
Yeah. Couple of questions here with regard to the distributions. The initial distribution, be call income or return of capital, and if a return of capital, does this dilute the percentage of holdings? Not sure if I kind of delivered that accurately. Does that make sense? Can you see the last couple of questions there?
Yeah, John, you want to chime in on that one? I'm gonna let percolate in my mind just a little bit there.
If any capital that's given out is going to be considered return of capital, obviously, as you know, if you know anything about return of capital, it's going to be technically a non-taxable event until you hit your capital contribution into a deal. So whether you're on a GP side or the LP side, that return of capital treatment is the same from a taxation perspective. Obviously, we're not tax advisors. I would ask you that you check with your tax accountants, but the return of capital should not necessarily dilute the percentage of the holding, because if you're getting the return of capital, that means you're probably giving out distribution, unless there's a liquidity and a cash out event to some of the investors. That's completely different. And Rick can expand on that more, if we have more intimate conversations, I guess, with people that decide to pursue this a little bit more diligently.
That was an interesting, very good question, by the way. And E. Bailey is our CPA firm. I think that I need to make a call and get a firm answer on that, on the dilution part of it. That was the portion that is kind of percolating. So thank you for that question. It's something that I want to find a very clarified answer on.
We're at that kind of like that hour mark. I believe we can maybe hit a couple more questions. I like this question because I think I know the answer. But why would you open GP stake to public, right? Why would you open this up? Why would you let these economics play out? GPs are supposed to be the managers who use their experience and knowledge, et cetera, right, to earn those outperformed returns. Why open the door and let me in? That's a great question, I think.
Yeah, and I'll be happy to answer that. This is a special situation, and we all look for special situation investments. And the answer to that, and by the way, our presentation deck, which is available for download, has a couple of great videos that are embedded on page 3. So I encourage you to download the deck and work through those videos. Where we are in life, the founding partners, as you saw at the very beginning, we don't want to do a traditional growth pattern for a private equity company. We want to go big fast. We have the firepower and the expertise to execute very quickly. And so we're utilizing a GP stake to enable us to hit that scale faster. The reason we're opening it to the public is, for that very reason, to allow the public to participate with us. And so it's now, when you say public, again, we anticipate that most of this will go probably, at the institutional level. But we're I've always been for, inclusion and open source and things of that nature. I was a big proponent of the relaxation of the SEC regulations to allow more people to participate in private placements. And, this is just a continuation of my personal philosophy of letting people that understand it and, are qualified to have access to it.
Beautiful.
It's something that GPs don't offer very often, and there's a reason for it. They don't want to share those GP economics. In our case, we want to go big fast. We see a window of opportunity, as we hope was kind of apparent to to the attendees here. And so we're going to use it to leapfrog that traditional sponsor growth pattern.
No, I like it. And I that's what I figured the answer was. I got that one right. Teach. I can tick that box. I got an A+, John. I got an A+. The ability to leverage. Leverage is a word that's bandied around a lot in business, finance, and leverage means, a million different things to a million different people. Leverage, when used appropriately to create opportunities for both parties involved in a scenario, I think leverage works the way it's supposed to in those scenarios. So leveraging investor capital, bringing them in, letting them participate, and share in the the outside economics of owning a piece of a private equity real estate firm. That's the power in the GP. I'll keep going all day and all night, but we got a couple more questions. Where is a link for the presentation? Somebody's looking to download the presentation. I'm sure somebody can answer that question.
Yeah, we'll add it to the site.
All right, thank you. Appreciate you, Jeremy.
It's actually already there, but it'll be on the recording page as well.
All right, perfect.
And also, Dave,
sorry.
Feel free to reach out to us, and we'll be happy to provide, like I said, provide lots of, we have lots and lots of material and research and business plans and things of that nature. People want to go into that deep.
And Jeremy, will you be able to capture some of the remaining questions and we can get back to the folks that have not been answered? I just don't want folks to think that they have not gotten their answered questions.
I'm recording them, and then also I'll have them for you and we can give it a few more minutes, and then we can shut it down, and then I'll get you the rest of the questions.
Beautiful. This is a great question as well. If you include so many GPs, would this complicate the decision making? What about control, right? If I'm a GP, I get to pick the paint colors on every single property that we buy. How do you work around that one, Rick? John?
Yeah. Now keep in mind, this is a passive investment. It's a way of looking at this is that you're buying shares in our company. I think because it's called a GP stake, it's the term that originated after the great financial crisis, 2008, kind of confuses people. You're not actually a GP. You're an investor in a GP. And so you're a shareholder in the GP, but it's being led by the founding partners. And you're a passive investor that owns shares, in a new private equity real estate company.
So you're essentially getting the economic benefits of owners. You're getting the owners' economic benefits, but you don't have to worry about picking out paint colors. As Dave.
Everybody's watching HGTV, John. We all want to pick out the pillows and the paint colors. Come on now.
I know, man. I know. We can't all be like you, man. So
yeah, right. Tenants, toilets, and trash is on our side of the equation, not on the investor side of the equation. We got that. We got that covered. It's up to you guys. I can read a couple more of these off.
One more, and then
I'd say probably one more, Dave,
okay.
and we can come to a conclusion.
Great question. What's the liability for other co-sponsors, GPs that come into the fund? Am I liable for the debt? Am I liable for, what's my exposure is really, I guess, what every investor would like to know, correct?
Yeah. And again, it's just your limited liability. This is, again, just like you'd be a shareholder in any other company. It's passive. You're not liable. As far as being liable on any debt or anything of that nature, absolutely not. That's at the corporate level. Beautiful.
Do one of you guys want to wrap this up with some words of wisdom? The first thing I would say is I appreciate being able to join you guys on this webinar. I've learned a lot myself. Might take some of them strategies back to my own business, Rick. Thank you. But what I would kind of stress is that those that seek shall find, right? Reach out, ask the questions. It may not always be a fit. I've been very cognizant of that in my own career, that not everybody is a great fit. there is plenty of capital in the marketplace. So a conversation with the team members at Essential Realty Partners is recommended. Get the information necessary so that you can make some educated decisions, because I believe, you could give me 2 seconds to share, I believe that the transition that we see economically, not only in real estate, but in business, just the way that we operate as a country, what we see happening in the next 24 to 48 months will be transitional. It will absolutely change the financial landscapes for many people. There will be some that are absolute victims, and unfortunately that's just the way it is. We can't control everything, but there will be people who see opportunities and will be the victors of the next cycle. So that's my 2 cents. If either one of you guys, it would be great if you could just wrap it up, and we'll leave it at that.
Yeah, I'll save the John's wisdom for the very last, because he's always he's got that philosophy that we all like to listen to. But for my wrap up here, if you want to participate in this sector, get in the private equity world, and participate in a basic need sector, which is housing, rental housing.
Mm-hmm.
We all know the demographics and how hard, we're turning into a nation of renters. So the long-term aspects are, long-term fundamentals, I should say, are absolutely astonishing. Unfortunately, 2 of our kids have homes, so one doesn't. We're trying to get him in one because we see what's coming down the road. But anyway, if you want to get in the business, this is a way to scale massively into the business. And it's also a way to time it. We all look back and say, man, if I would have bought when, everything went to pieces. Well, folks, we've done our homework here, and, this is a perfect setup. So it's really an opportunistic investment. And like I said, GP stakes aren't offered that much, especially at this level. And so, it's a rare opportunity. Everybody says that, but this is truly unique opportunity to get in and really leverage something on a massive scale with us.
Awesome. John, put the cherry on this cake. Come on now.
Well, I'm going to say, look, the way that Rick organized Essential Realty Partners is a very unique way to approach the sort of the entree into multifamily from a GP perspective. And, it's really done in a really cool way where the capitalization of the company itself matters a lot. It matters on how impactful the acquisitions are, and matters how impactful the returns are, and what kind of entry into the marketplace will play out. And listen, there was a question in there, and why do you feel like you can still buy multifamily assets right now? We're doing this right now because it doesn't really matter when you enter the market. It's how you enter it and what you do while you're in the market itself. One of my earliest mentors in my career have told me it's not timing the market, it's time in the market. And that's what we're trying to do here. We are, you're going to have to spend time in the market no matter what the market is doing. It doesn't really matter what the market is doing, as long as the diligence and the underwriting and the screening is done correctly, which is what we're trying to do on a day-to-day basis. And this opportunity presents a way for folks to participate at the and they get the economics of the top level of the chain in terms of the GP, in terms of the ownership structure. So it's giving the best economics returns for that would be endowed to GPs, but shielding you from all the other headaches, including picking up paint colors and decision making and liability that comes on the GP side. So it's you're cherry picking the best, which is essentially the GP, the economics of being a GP, but none of the other downside of being a GP.
Thank you, John. That was a cherry and icing and extra icing on that cake. I appreciate it. Jeremy, I'll turn it over to you to I assume to wrap this webinar up.
All right, well, thank you, gentlemen, for joining us and giving us such an informative webcast. The site, we will have the content on the site, and like they stated many a times, you can reach out to Rick and John with your additional questions. Thank you, and that concludes this webcast.